I'm Carson Block of Zeros TV, and really pleased to be here today with Jamie Catherwood. Jamie by day is with O'Shaughnessy Asset Management, but by night, Jamie teaches online courses in financial history. His website is aptly titled Investor Amnesia. Jamie, thank you so much for being here and welcome.
Thank you so much for having me. Really looking forward to this.
Your Investor Amnesia courses specialize, or they focus on bubbles, the history of financial bubbles, fraud. Any other areas there that you touch on?
Yeah, so the first course I launched in November of last year was on bubbles, manias, and fraud. And then just, I think under a month ago, or almost exactly a month ago, I launched a second course titled Imperial Finance, which looks at the kind of financial history of empires, both corporate and sovereign, and kind of the patterns of rise and fall of empires, or if there are any similar rises and falling patterns. But the first course was definitely a probably more fitting topic for our conversation. And it's one that people love reading about the most because bubbles, manias, and fraud are kind of the three sexiest areas of financial history, all wrapped into one. And excited to dive into that further with someone who's an expert on fraud.
Well, his first question is it ever really different, or are we just repeating the same thing time and again when it comes to assets that appreciate significantly in relatively short periods of time?
So as much as I hate hearing the phrase now after doing financial history for a couple of years of history doesn't always repeat, but it often rhymes, it is an accurate statement. And so there's definitely no kind of set pattern that markets just repeatedly follow to the T, but there are definitely overarching kind of themes and trends that investors can pick up on by looking at the hundreds of years of financial markets and investors. And the analogy I often use is that history should be thought of kind of like a compass instead of a GPS or map with a very specific route that you take. Markets don't start here and then follow the same route to get to the end or progress forward. But using history, you can kind of utilize it as a compass where you can see, okay, this is what happens in these periods over and over again through hundreds of years of investing. And so I can at least point myself in kind of the right direction and better orient myself for successful investing outcomes. So I think that's a more kind of fitting way to think about history than, look at this chart, matches exactly Enron or exactly the 1929 crash. So that means we're going to experience the exact same thing. That is very unlikely to be the case.
So what do bubbles generally have in common then? And at what point do you feel like a bubble can be identified? Is it only post facto, or is it possible to accurately identify a bubble in the moment?
I feel like there's such a range of types of bubbles that it's kind of hard to categorically say it's one of those two. But one of the kind of themes I've written about before is this type of speculation and innovation cycle that you see with bubbles, where I think we saw this last year and still are seeing it to a certain extent, where you'll often have in a new sector or industry or around a new technology that's exciting, you'll have one company that's kind of the innovator, and they'll come out and be really successful early on, and they'll have outsized returns. And then everybody who didn't get in on time to experience that rally starts looking around and seeing people they know make a ton of money. And so then what happens is they start looking for the next innovative company in that space to kind of catch up and make those similar returns. And to take advantage of that, a lot of imitating companies kind of crop up and take advantage of that excitement. And eventually you just get straight up fraudulent companies who are just trying to ride the trend and take advantage of gullible investors. But that kind of innovator, imitator, idiot cycle, as Warren Buffett termed it, is one that you see play out repeatedly over history. So even in the 1890s, there was a revolution in bicycle companies, if you can believe it, a different transportation mania, where I think something like 672 bicycle companies IPO'd on the British stock market in 2.5 years, which is just, if you think the EV SPAC boom is crazy, imagine 671 EV companies in 2.5 years. And again, you saw this kind of early rise in bicycle shares. And then at a lag, you see a ton of new bicycle companies getting formed. And I think more recently, to bring it back to modern times, you saw this last year with this rapid rise of Tesla shares earlier in the year. And then it was after that there was an explosion in all these kind of EV SPACs. That's when Nikola kind of came out shortly following that Tesla rally. And that was just funny irony that it was named Nikola and Tesla was the original innovator there. But I think that cycle is one that you just repeatedly see throughout history. And that is a type of bubble where you can kind of identify it in real time because it's just obvious that people are hurting in to try and find the imitating company that missed out originally.
Well, you're also fond of pointing out that there was previously, over 100 years ago, an electric vehicle bubble in the U.S. stock market. Is that accurate?
Yeah, so I don't know if I'd say there's a bubble in the stock market because I'm not sure how many of the companies actually went public, but there was one aptly titled the electric vehicle company, which was a fraudulent scam. But yes, to your point, so up until I think 1912, electric vehicles were actually kind of the dominant form of transportation out of all automobiles. I think in 1912, there were like 38,000 electric vehicles on the road. And Henry Ford's wife actually owned a Baker Electric. They were popular with women because the Fords at the time, you had to hand crank them to start. And it was so dangerous that there was a term at the time called Ford fracture, where people would snap the crank as they were cranking it up to start the engine, and it would just like totally fracture their wrist. And so women preferred the electric vehicles because it was a push to start and you didn't have to do this hand crank method. And so it was much more popular. And then eventually the internal combustion engine kind of adopted that ignition technology, and then they just kind of dominated. But yeah, it's funny to think about an explosion in electric vehicle companies and excitement from investors happening not in 2020, but in the 1890s.
Yeah, because you've pointed out on Investor Amnesia that some of those EVs actually had ranges of over 200 miles.
Yeah.
It's definitely rhyming at this point. But when you look at Tesla and the EV bubble that we're in right now, I think it's quite likely that Tesla survives for some period of time. It's raised huge amounts of cash. It can continue to raise at this market cap that it has. Would that be unique, or do you often see companies that the leaders, the innovators of these bubbles, do you often see them surviving and thriving as time goes on, or is this maybe somewhat of a different paradigm here?
No, I think it's usually those innovators, the early ones are overall, obviously there will be exceptions. Overall, they are the ones that tend to persist, and it's usually those ones that kind of follow them and get swept up in investors' excitement that turn out to be less kind of sustainable in terms of their business model, because largely investors are getting enthusiastic about it because of the original innovative company. And so they're just pouring money into companies that might not really be that sound and fundamentally stable.
When you look at, say, the tech bubble of the late 90s, some of the leaders there, like Yahoo, that's still around, but it perpetually on life support.
In pieces.
Yeah. And then, Netscape, which, that got acquired away, and AOL at one point was huge. But then on the other hand, you have Amazon, which has thrived to this day. Do you think that there was, and I was talking actually with Andrew Left a few months ago about today's bubbles versus the tech bubble. One of the points that he made to me is he said, when you look at that tech bubble, there was actual value that was created. It's just, it took a long time to realize it. But the big, like Blockbuster Online, that's today it's Netflix. Is that something that is, you think, typical, or do you think that's an apt description of the late 90s tech bubble? And, and Andrew then compared it to today, in which he said he thinks very little useful is going to come out of the bubble or bubbles that we see today.
Yes, I think that's definitely an apt description. And in addition to the tech bubble, I think another great example of that is the railway mania of the 19th century, where kind of similar to the tech bubble, where it was laying infrastructure in terms of fiber optic cables, et cetera. In the 19th century, it was laying literal railroad track and connecting America, which set ourselves up for a transportation boom and really just heightened the amount of commerce we were able to do and distances we could cover. And I mean, I think it was 1868 where the Transcontinental Railroad met in Utah, but that whole experience was one of just wild speculative mania. But at the end, while there was a lot of fraud and a lot of companies that went bankrupt, there was still a very productive and useful groundwork laid during that period that then we as a nation could take advantage of after the bubble kind of subsided and the companies that were strong kind of rise from the ashes and take advantage of this vast network. Today, it's hard to say. I feel like with climate change and everything, that there will still be some sort of benefit, whether it's to the extent of the tech bubble and the railway mania is a different story. But I do think that some sort of focus and international attention to areas like electric vehicles will be beneficial to society in some way. But I wrote a paper earlier this summer, kind of digging into this a little bit more, where I think that there's an opportunity for the government to replicate that kind of railway boom in some way, because the railway boom was really sustained by government incentives being used to induce private investment, where they said for every mile of track that you lay, you get X acres of land, which you can then sell to finance your company, and we'll also just give you straight cash for every mile of track you build. So a lot of people that want to make money saw the clear incentive, I should start building railroad track. And so all these companies were formed. And as some companies started making great returns in the market, investors were all too happy to invest their capital, and it made starting up a railroad company very easy because money was so easy to come by. And I think that today there's some sort of opportunity to do something similar if the government can figure out what type of large and grand scheme we as a nation should be looking to accomplish. And if they provide the right incentives, then like the railroad boom, we can kind of induce that private investment, and in a way that perhaps the average investor can get involved with and produce something valuable, like happened in the railway mania of 19th century.
Is there a consistent pattern as to who net makes money in bubbles, or how to net make money in bubbles?
I think it's a lot of just knowing how to time the momentum and ride the wave, as it were. And having, it sounds ridiculous if we're talking about a bubble, but some sort of valuation discipline just to ensure you're not buying at the top and then just riding it all the way down. I think that just trying to find the investors that can find that right balance of valuation and momentum during bubbles are the ones that tend to do well, because they can ride the momentum up, but then not let it kind of run too far and then get caught when it all comes crashing down.
It sounds like you can make that money as an imitator, basically, in using that 3 eyes framework. How about idiots? Idiots make money?
Idiots, not so much. Well, I guess idiots might make money and then disappear into the night with your money. But in terms of investing in the idiots, it doesn't tend to work out so well. I would not say that idiots are a profitable venture to invest in.
Okay, so then to clarify, and I didn't quite catch this earlier. So the 3I framework really just refers to issuers. So you've got your
yes.
Okay, so when I thought about idiots, of course, I was thinking about retail investors who rush into various EVs.
Well, I guess it has a double meaning there.
Right. Okay, so
but the 3 eyes in general does refer to the companies. But I guess if you're following into those idiot companies, then I guess you could partially call the investors idiots as well.
Right. Okay. Well, so to be a little kind, we'll maybe switch the terminology. But one of the things that when I step back, and I don't know, maybe it's because I grew up in the industry, and I don't know, but it just seems, I'm fond of saying we've seen this movie before. And every single time we see this movie, you have this rush of retail or unsophisticated money. I mean, but they are aware, right, that when things do this, it's often a bubble, and aren't they? And I mean, do you have any insight to the psychology of, like this type of speculator, and why they, are they aware of history at all, and they think that they're different or special, or do they just think, are they kind of in on the joke and just think that they're going to get out in time? I mean, what drives this?
I think it's all of the above. So what is most kind of, I guess, simultaneously depressing but fascinating about financial history is that everybody in the present tends to look back at previous investors who get swept up in bubbles and manias, et cetera, and think, wow, 100 years ago, they were so stupid. Like, how could they not see this coming? But then we do the same thing. And in 100 years from now, the future Investor Amnesia writer will be saying the same thing about what's going on today. To your point, in 1825 in England, it was a crazy speculative year. I mean, if you want to talk about a fraud, basically after the Napoleonic Wars, the British government had this massive debt load, and they needed to figure out a way to reduce those servicing costs. And so they started converting their debt into lower yielding consul bonds, their long-term government bond equivalent, and purchasing back the higher yielding debt and then reissuing at lower rates. And so suddenly investors found themselves in a very low yield environment. And as is often the case, they turned to more speculative investments to kind of make up that income that they had lost. And around the same time, a lot of Latin American countries were gaining independence from the Spanish Empire. And so they were these new nations that needed to raise money. And so they started listing bonds on the London Stock Exchange. And in a time of low yields in England, British investors just lapped up these Latin American bonds that were paying sometimes like 10% yields when British consuls were paying 2.5% yields. And in this type of environment, a guy named Gregor McGregor literally made up a country in Latin America called Oye, totally fictitious. It was like a jungle island. And he sailed back to London and said it was, a magical paradise with opera buildings and parliamentary institutions, et cetera, when it's just a jungle. And to be fair to them, again, at the time, who's to say if you're just some guy in London in 1825, how would you know whether Poye or Honduras is a real country? You're not going to have been to either of them. You won't know anyone that's been to either of them. The telegraph isn't even operating yet. And so they just bought these bonds because they are a 6% yield, which is 3 times what the British consul was. And I think in the end, McGregor floated like $1 billion in today's monetary values. And it was all a fraud, and eventually it got found out. But to your original point, that was in 1825, and in 1825, a couple of investors wrote a book reminding British investors of what had happened in the 1720 South Sea bubble, and they say in the introduction, the sole point of us writing this book is to remind investors of history and what happened the last time there was a kind of national speculative mania like this, where people were just hurling money at new companies floating on the exchange. And you need to remember how bad it was after the South Sea bubble crashed. And so people were very aware at the time, and it did not stop any of the sham and fraudulent companies of 1825 being listed. And so there's always this understanding of financial history, but there's just something about investors' kind of predisposition to only trying to get rich quick instead of working for money slowly that keeps us kind of succumbing to the same boom bust cycle.
Well, yeah, I mean, you talk about the cycle and that Latin American bubble in 1825, and the first thing that came to mind as I heard you talking was, and Argentina continues to get money and default consistently. I mean, it's like this lesson has not been learned. I think Argie's defaulted 8 or 9 times on its sovereign debt, and they'll do it again, I'm sure.
They set off a bubble in 1890s. That same Latin American debt boom in the 1820s happened again for the same reasons in the 1890s, and in I think 1890. The Bering crisis was set off because British investors were hurting into Latin American debt and South American debt, and then Argentina defaulted, and Barings Bank was heavily exposed there. And so history really repeats. Argentina again bringing down the financial system by defaulting on their debt.
And of course, well, Barings Bank took another 100 years to completely go under.
Yeah.
And that was out of Singapore. But well, one of the things that's different today that wasn't necessarily present, and I guess you'd have to understand the history of central banking, but wasn't present in some of these bubbles, is central banking and the role that it plays. Do you see, is behavior of bubbles, is it somewhat different in the era of central banks, large central banks, than it was pre, or does it pretty much play out the same way?
I would say it generally plays out similarly. There were different kind of quirks to the financial system that would produce panics and crashes when we were on the gold standard and kind of the pre-Fed era. There's a lot more seasonality issues with like crops and stuff in the fall and contractions in money supply. But there were also in the 1820s in that bubble, that was kind of when lender of last resort concept was first instituted at the Bank of England, because they waited too long to come in to kind of arrest that bubble and arrest the decline. And then from then on, that's when they kind of learned that this was our role to kind of stop panics by being the lender of last resort to other banks as there's financial panic. So there's always been some sort of kind of governing institution that is, whether it's an official central bank like we would consider it today. There, even in the U.S., we had the first and second national banks of the United States for a good while at the beginning there, until Jackson got rid of them in the 30s. But there's always been kind of this control of money supply in one way or another. And when money is flowing, then bubbles happen. And when it tightens up, then the bubbles usually are popped. And so there's kind of a consistency whether there's a official central bank or not.
Do you have a sense of all the bubbles that you've studied, which have all burst? Do you have a sense of which one or which ones were the most damaging to society or to the economy on a medium or long-term basis?
One of the ones that was damaging, and it's interesting in terms of kind of how, so the Industrial Revolution, basically, some have argued could have been like 100 years earlier if it wasn't for the Bubble Act following the South Sea bubble collapse. Because essentially what the Bubble Act said was that in order to form a company, you had to receive a charter from the British government. And really, they were doing that because they had a financial stake in the South Sea Company. And so they were just trying to eliminate the competition by saying you can only really form and list your shares if we approve you. And you can guess that they were not too approving of rival companies to the South Sea Company. But after that bubble collapsed and that rule kind of stayed in place, it really stifled innovation and progress and technological innovations until the act was repealed. I could be wrong, but I want to say that it wasn't repealed until sometime well into the 1800s. But you just think what could have happened in that kind of 100-year-ish window if there wasn't this kind of restriction on the ability for people to form companies and list their shares for trading on the exchange. So I'm sure there are definitely many with more concrete economic consequences, but I've always found that one to be interesting because it's just kind of one of those interesting what if questions, because we don't know what would have happened, but odds are that if the Industrial Revolution followed the kind of collapse of that Bubble Act regulation, then it could have happened a lot earlier had it not been instituted in the first place.
You've made the point that post-bubble bursting, policymakers often make pretty grievous errors. The example I always cite is post-financial crisis, the European Union decides that it has to crack down on short selling and make it harder to do. How much of a factor, how consistently do policymakers come out with bad prescriptions post-bubble burst? And why is that?
Well, if you want to talk about one of the most often repeated kind of themes in financial history, it's banning short selling after a crash occurs. That's been happening for 400 plus years. The first example was in 1610, I believe, with the Dutch East India Company, where I think we'll get into it later, but there was the first kind of activist short selling campaign. And as it started to go well, the Dutch East India Company, which was very closely intertwined with the government, went to the government and was like, you got to stop this. And so they just put a ban on short selling. And that was the first example. And you see it countless times over the following centuries, Napoleon outlawing it in the 1800s, et cetera. But I think there's just a kind of human tendency to react strongly and swiftly when probably taking some time to really think through policy is the better approach. But there's just this strong knee-jerk reaction to whatever's just happened, and you tend to overcorrect rather than reacting kind of appropriately.
Now, this might be something really, really hard to answer, but you have spent some time thinking about it. Love to hear your thoughts. Given that there is often this impulse to react post GameStop, AMC, I mean, there are congressional hearings on this. There's a lot of talk from policymakers about doing something. Any predictions on what will be done or whether it'll be good, or what do you? Does history serve as a guide here?
Honestly, I'm sure it does in some way, but I haven't thought about that as much. So I'll keep thinking as we talk, and maybe I'll come up with a good answer, but I don't have any kind of prediction off the top of my head. One interesting thing I would note on that is it's interesting this episode versus historical comparisons, because in the past, it's always been the retail investor fearful of kind of trading against big institutions or huge traders that have, whether they have inside information or not, they just have the money to kind of move prices. And so it's always been this fear of going up against them. There's even an article about actually during the bicycle mania that for short sellers, this fear of being cornered by shorting a popular kind of, in those days, bicycle meme stock acted as a short constraint because of just that fear of trying to short a popular bicycle company and then getting caught up in a corner. Again, that would be someone fearing the big institutions. And I just find it interesting today that now it's kind of the exact inverse, where although there's obviously a lot of big players involved in these stocks, and it's not just this simplified narrative of little guy versus the big guy, it is interesting that there's these episodes of hedge funds and larger institutions being worried about whether this retail Reddit mob is going to get into a stock that they're shorting or involved in. And so it's just kind of been flipped on its head.
One thing we haven't talked about yet is how bubbles actually burst. There's probably the popular narrative around the tech bubble is that the Fed raising rates caused the bubble to burst. But there are others who say, no, it's just the supply of, the idiot issuers, the idiot companies exceeded demand. And once investors lost money, it's this spiral where they lose confidence and they lose their appetite for risk, and more investors lose money, and so on and so forth. Is there a common thread that runs through most bubbles bursting that you see?
There's a really good framework for how bubbles form, and the same framework kind of explains why bubbles burst. And so John Turner and William Quinn from Queen's University Belfast came out with a great book last year called Boom and Bust, History of Global Market Bubbles. And they put forward this concept of the bubble triangle framework, which is a financial interpretation of the fire triangle. The fire triangle is heat, oxygen, and fuel. And you need those three things and a spark to kind of create and sustain a fire. If you take away any of those three things, then the fire goes out. And so for markets, they use this bubble triangle to update it for investing. And so instead of heat, oxygen, and fuel, you have speculation, marketability, money, and credit. And then the spark is either a political and policy change or a technological innovation. And so for heat, that's speculation. You need this kind of just that speculative fervor and excitement about stocks or an industry to keep the bubble going. But then you also need marketability. And by marketability, they don't mean in terms of marketing and like advertising, but the ability to easily buy and sell an asset. So today we arguably have more marketability than ever with Robinhood and other, well, now all brokerages having commission-free trading, fractional shares, et cetera. And so that makes it easier to sustain a bubble. And then the third side, which is the oxygen, is the easy money and cheap credit that central bankers provide, because it's easier to start and sustain companies and sustain, it's not necessarily good companies, with low interest rates. And it also forces investors to go out further on the risk spectrum. And then again, it's usually sparked by some technological innovation or policy change. And if you take any of those three sides away, then you'll often see the bubble collapse. Just like if you take away one of the three sides of the fire triangle, the fire goes out. And so to your point, for the money and credit side of the triangle, if you raise rates and that suddenly becomes something not conducive to speculation, then a bubble typically collapses. Or for speculation, if one of the idiot issuers takes things too far, which is often the case, you can get away with a little bit of like pushing the narrative and kind of stretching the imagination a bit. But then there's usually one company that just tries to push it a little too far, and investors smarten up. And then after that, they start reassessing all the other companies that are popular in that period. And so that can cause the kind of triangle to collapse. That framework is good for understanding why and how bubbles form, and then also how they collapse, because it's usually almost in every bubble, some combination of those three sides of the triangle.
As you said, that was written in 2020, right?
Mm-hmm.
So I have to wonder if it needs a little tweak, because as you said, that model revolves around the idea that the spark is either political change of some sort or technological. And yeah, when we look back at history, I mean, we see a lot of these a lot of the bubbles inflate around some claimed, anyway, new technology. But when you look at AMC, when you look at GameStop, I mean, I don't think it's policy change, and it sure doesn't seem like technology. So is there something new that we need to consider in this model?
I definitely need some updating, because that does not fit that narrative. It is definitely, this episode is one that does not have as much historical precedent as the kind of traditional bubble. But yeah, so it definitely might need some tweaking. Maybe in the second edition, it'll have an update.